Welcome to Talk Tickers. We digest the data so you don't have to. Today, we're tackling the latest earnings call from Autoliv Inc. That's for their first quarter of 2025. We'll break down the numbers, the management chat, and what it all might mean. So, what's the big picture here? How do they kick off the year?
Well, overall, Q1 painted a picture of resilience, I'd say. Autoliv showed they can adapt. Now, reported sales, they were actually down slightly, about 1% year over year.
Okay, down 1%. Why was that?
Mostly currency effects and also some, shifts in light vehicle production and the product mix. But if you look at organic sales, so stripping out the currency impact, they actually grew by 2%.
Ah, okay. So underlying growth is there. What about profitability? That's often the key number.
Absolutely. And that's where they really shone. Adjusted operating income saw a pretty significant jump, up 28% to $255 million.
28%. That's quite a leap.
It is. And it pushed their adjusted operating margin up considerably. It hit 9.9%.
And how does that compare?
That's a 230 basis point increase from last year. So 2.3 percentage points higher. Really solid improvement there.
Makes sense. And bottom line, earnings per share.
Record first quarter EPS, actually, helped by having fewer shares out there because of buybacks and just higher net profits overall.
Good stuff. Anything else stand out financially, like cash or returns?
Yeah, return on capital employed held up strong. Cash flow solid too, though. Receivables did tick up a bit. Money owed by customers,
Right. Sometimes happens with timing of sales and shareholder returns.
Right.
Still happening.
Oh, yeah, definitely. They kept the program going, bought back 500,000 shares that cost them $50 million, and they paid out a dividend, 70 cents per share.
Okay, so returning cash is still a priority.
Yeah.
What was the mood from management looking forward? Optimistic? Cautious?
I'd say cautious optimism. They flagged potential headwinds for the rest of the year, tariffs, general economic factors, that sort of thing. But they also made a point of saying they actually outperformed global light vehicle production in Q1, even with those headwinds.
Outperform the market. That's interesting. Despite the overall sales dip you mentioned earlier.
Exactly. Which points to maybe gaining some share or having a better regional mix, except maybe in China where mix issues were a drag.
Okay, let's dig into that sales performance a bit more. Where is the money coming from geographically?
Right. So the breakdown was roughly China 17%, Asia, excluding China, 20%. The Americas were the biggest at 33%, and Europe at 30%.
And you said they outperformed light vehicle production everywhere except China.
That's right. They saw really strong growth, actually, with the domestic Chinese OEMs, the local car brands. Sales to them were up 19%.
19%. But overall, China sales were dragged down by mix. How does that work?
Yeah, it's about which vehicles are being produced. The overall mix of cars being made in China right now just happens to rely less on Autoliv's specific parts basket, even though they're doing well with certain local manufacturers.
Got it. So it's not that they aren't selling to China. It's just the overall market composition there wasn't in their favor for Q1.
Precisely. And they highlighted some key model launches too, mostly in the Americas, Europe, and South Korea for Q1. They are expecting some big launches in China in Q2, though, especially after the Shanghai Auto Show.
Okay, something to watch for. Do we know how much Autoliv content is in these new vehicles?
It varies quite a bit. The content per vehicle they mentioned ranges from like 130 up to nearly $500. Depends heavily on the model and its features.
That's a huge range. Definitely makes those China launches potentially very impactful.
Yeah.
Let's switch back to that profitability jump. How exactly did they boost the margin so much?
Well, the gross margin improved first, up to 18.6%. That's a 160 basis point increase.
For that reason.
Primarily better direct labor efficiency and also, like we touched on, headcount reduction. Fewer people doing the work more efficiently.
Makes sense.
Yeah.
And the adjusted operating income, that 28% jump, can we
Yeah.
break that down?
Sure. They provided a kind of bridge. So the core operations, higher organic sales and efficiency added $46 million. That's the biggest piece. Then you had some negatives. Currency effects took away $5 million. Raw materials cost about $5 million more.
Oh, okay.
But then some positives. A $4 million benefit from some out-of-period cost adjustments. SG&A and R&D costs were slightly down, net. And interestingly, a $12 million positive impact from some accounting related to currency translation from their old Russia business divestment.
Ah, a one-off benefit there, sounds like.
Kind of, yeah. And finally, a $2 million negative hit compared to last year from a supplier settlement. So lots of moving parts. But the operational improvement was key.
It really sounds like that focus on efficiency and cost control is paying off. That workforce reduction you mentioned earlier sounds significant.
It was. They cut 3,700 direct production staff compared to Q1 last year.
Wow.
And they credited automation and digitalization efforts for helping make that happen while improving productivity.
Okay, let's shift gears to cash flow again. You said operating cash flow was down because receivables were up.
Yeah, operating cash flow came in at $77 million, which is lower, primarily that increase in money owed by customers.
But they spent less on capital expenditures.
Correct. Net CapEx decreased. So when you net that out, free operating cash flow is actually negative $16 million for the quarter.
Negative 16.
And net cash conversion.
Came in at 72%. A little below their target, which is usually around 80%.
Okay. What about working capital overall?
Trade working capital actually decreased. Lower payables money they owe suppliers and lower inventory helped offset those higher receivables.
And their debt level, given the buybacks and dividends.
Pretty steady. The debt leverage ratio stayed almost flat year over year, around 1.3 times earnings, despite those significant shareholder returns.
Yeah.
Shows good discipline.
Yeah, that is pretty stable. Okay, let's talk market conditions. Tariffs are the big boogeyman for lots of industries right now, especially auto. How's Autoliv handling it? Yeah, tariffs are definitely a major challenge. Potential to hike vehicle prices, potentially hurting demand. You know the drill. Autoliv seems proactive, though. They've got a task force working on it, and they're actively talking with customers about compensation for the extra costs.
Compensation. So getting customers to pay for the tariffs.
Essentially, yes. Passing the cost through. And they said they were actually successful in passing on the vast majority of tariff costs in Q1.
That's huge. Is that sustainable?
That's the big question, isn't it? Especially if tariffs escalate. For now, it's a positive sign.
Do they have options like shifting production? They mentioned a U.S. footprint.
They do. Having plants in the U.S. gives them options to ramp up production there if needed, which could help mitigate some tariff impacts. But they also mentioned a challenge with the USMCA, the new NAFTA. Certain materials aren't available regionally, things like specific leathers, magnesium, some electronic components. That makes full compliance tricky.
Right, the rules of origin can be complex. So passing costs worked in Q1, but regional sourcing limitations are a constraint. What about the overall market view from Autoliv?
Global light vehicle production actually declined slightly in Q1, but it was better than some earlier, more pessimistic forecasts. China saw strong growth for its domestic OEMs, as we discussed, but North America and Western Europe saw declines. And that unfavorable regional mix slightly hurt Autoliv's overall outperformance against the global LVP number.
Gotcha. So looking at the rest of 2025, what's the official guidance or outlook?
They're definitely bracing for a challenging year for the industry overall, but they expect their own focus on efficiency to keep boosting profitability, and they specifically anticipate a, quote, significant sales performance improvement in China as the year progresses. Those Q2 launches are probably key there.
Okay, better China sales expected, and shareholder returns continue.
Yes, strong cash generation and a solid balance sheet should support continued high shareholder returns. That seems to be the message.
What about cost pressures? Are they expecting more?
They are. Mainly labor costs, Europe and America were mentioned, and potential inflation from tariffs, obviously, and maybe some raw materials in the U.S.
And how will margins progress? Quarter by quarter improvements like recent years?
Interestingly, no. They explicitly said not to expect that kind of steady, sequential, quarterly margin increase we saw over the past 3 years. They still think Q4 will likely be the strongest quarter, which is more of a, traditional seasonal pattern, but maybe less smooth improvement along the way.
That's a really important nuance for expectations. Any specific numbers in the full year guidance?
They're basing it on a few assumptions. Global light vehicle production down about 0.5% for the full year, a tax rate around 28%, and a negative currency impact on sales of around 3%.
And the usual caveats apply, I assume?
Oh, yes. Excludes effects from potential restructuring, antitrust stuff, assumes no new tariff changes after mid-April 2025, assumes a stable macro environment, no major customer order volatility or supply chain chaos, the standard list.
Right, standard but important disclaimers. Any target for cash flow?
Yes, they're projecting operating cash flow for the full year to be around $1.2 billion.
Okay, $1.2 billion. And they mentioned an event coming up.
That's right. Capital Markets Day, it's on June 4th, 2025 in Stockholm, Sweden. Usually a chance for them to lay out the longer-term vision.
Definitely one for investors to mark on their calendars. So, pulling this all together, what are the key takeaways for someone following Autoliv?
Well, first, the Q1 results really highlight their ability to manage costs effectively. That profit and margin improvement, despite slightly lower sales, is pretty impressive.
Agreed.
Second, the cautious outlook is real. Tariffs in the economy are genuine uncertainties. How they navigate that, especially the ability to keep passing costs on, is crucial.
Yeah, that Q1 success might be harder to replicate if things get worse.
Exactly. Third, the commitment to shareholder returns signals confidence, but keep an eye on that debt level, even though it's stable now. Fourth, the regional picture is mixed. Europe looks strong, domestic China sales are good, but the overall China mix issue needs watching. Will those Q2 launches turn it around?
Good point.
And finally, that point about Q4 likely being the strongest, not a smooth quarterly rise, is key context for how the year might unfold financially. It signals a return to maybe a more normal pre-inflationary profit pattern.
Excellent summary. Okay, let's shift gears to our favorite segment, the outrageous but plausible trade idea. Remember, everyone, this is purely for discussion, absolutely not financial advice. What have you got for us today?
All right, how about this one? We know Autoliv is strong with European OEMs, right? And they've navigated the initial tariff stuff reasonably well.
Okay.
Where are you going with this?
Imagine a scenario where, maybe due to shifting regulations or incentives, light vehicle production in Europe gets an unexpected boost later this year or next, perhaps linked to revised EV targets or something similar.
Plausible enough. Europe wants to support its industry.
Right. So the trade could be go long Autoliv, betting on their strong European position to capture a disproportionate share of that unexpected upside.
Okay, long Autoliv. What's the other side? To make it a pair trade. You could pair it with a short position in a North American auto supplier, one that's maybe heavily reliant on the US, Mexico, Canada trade flows, and perhaps more exposed to potential disruptions or cost increases there, or maybe less exposed to the European market.
Oh, so you're playing a potential divergence, betting on Autoliv's European strength against potential friction, or just slower growth in the USMCA region for a competitor.
Exactly. It leverages Autoliv's demonstrated resilience and their specific regional strength against a supplier facing maybe different headwinds. Outrageous. Maybe. Plausible. If European production surprises, perhaps.
I like it, a definite thought provoker. Okay, let's wrap up our deep dive on Autoliv's Q1. A resilient start to 2025, clear focus on cost management, navigating those initial tariff waves.
Yeah, but the rest of the year definitely has its share of unknowns. Tariffs remain the big one, plus the whole global economic picture needs careful watching.
And the Capital Markets Day in June could offer more clues about their long-term playbook.
Definitely worth tuning in for if you follow the company.
Absolutely. So remember, everything we discussed here is just breaking down the information. It's not advice on what you should do with your money. Always do your own research. We'd love to hear what you think, though. How sustainable is Autoliv's strategy for handling tariffs? What's your take on their chances in China for the rest of the year? Let us know.